Hi everyone, I'm Keith Wood. Today our team is presenting our stock price prediction project for CAP 4630. I'll kick things off with the problem and data foundation, then hand it over to my teammates for the modeling, visualization, performance, and future work sections. Why stock prediction matters. Stock markets move billions of dollars daily, and even a small predictive edge helps investors manage risks. In today's data-driven world, investors prefer data-based decisions over gut reactions. AI lets us test predictive models on real-world time series data, exactly what we need for stock prices. By applying machine learning to historical data, we can identify patterns that might predict future prices. This project compares multiple AI approaches to see which performs best, evaluating both numerical accuracy and directional accuracy, whether prices go up or down. Our goal is to predict the next day's closing price for any stock ticker. Using Apple AAPL as our default example, we're comparing three AI models: linear regression as a baseline, random forest for nonlinear relationships, and LSTM for time series patterns. We'll evaluate using numerical matrix such as RMSE, MAE, R squared, and MAP, plus directional accuracy, which tells us if the model correctly predicts price direction. This often just as important to investors as the exact price. Finally, we'll deliver ready-to-use visualizations and reports. We're using Apple stock AAPL through system works with any ticker. Our date range spans from January 2019 to October 2024, about 5.5 years of trading data. After processing, we have 1,396 usable samples. Each row contains the date open, high, low, close, adjusted close, and volume. The daily HOLC captures trends and trading regions, while volume shows liquidity. Adjusted close accounts for splits and dividends, giving accurate historical values. We handle weekends and holidays automatically, and the data stays chronologically ordered. No shuffling. This is crucial because we train on past data and test on future data. We pull data from Yahoo Finance using Y Finance. If the API fails, our pipeline automatically falls back to a cached CSV file, ensuring the workflow always runs. We engineered 28 features beyond raw price data. Let me break them down into three categories. First, trend and momentum, moving averages at 7, 21, and 50 days, smooth out fluctuations. Exponential moving averages at 12 and 26 days, weight recent prices more heavily. MACD and its signal line identify momentum changes. RSI indicates overbought or oversold conditions. Second, volatility. Bollinger Bands identify when prices are unusually high or low. We also calculate 21-day standard deviation of returns. Third context is lagged closes from 1, 2, 3, and 7 days ago. Give our classical models short-term memory, allowing them to see recent patterns. Our target is the next day's close. Why these features, trend indicators mimic technical analysis signals. Volatility bands surface risk zones. Lag features give classical models the context they need since they lack LSTM's built-in memory. Together, this feature setup works for both classical and deep learning models. With these features with these features ready, we feed them into linear regression and random forests. Next, we'll see how we train and validate those models.
Hello everyone. My part covers the modeling strategy and how we train the models. After the dataset was prepared, we started by pre-processing the data. We created 28 technical indicators such as moving averages, RSI, MACD, Bollinger Bands, volatility, and several lag features. Then we removed any missing values from the rolling calculations, scaled all features using min-max scaler, and split the data in time order so the model trains on earlier data and tests on later data. For the machine learning part, we trained two main models, linear regression and random forest. Linear regression served as our baseline because it works well when the indicators have mostly linear relationships with price. Random forest is a more complex non-linear model, so it gives us a chance to compare simple versus advanced methods. The notebook also included an LSTM option, but we left it off because it requires more complex sequential inputs and wasn't necessary for this project. Our training flow is straightforward. Pre-process and scale the data, train linear regression, train random forest, generate predictions, and evaluate both models with RIMC, MAE, R square, and MAPE. And then we compared the performance.
Now let's go over some of the data visualizations. Here you can see the test results plotted against the actual stock prices and how they performed. The blue line represents the actual daily closing prices, and the orange colored lines show our model predictions. You'll see that linear regression tracks the real market very closely, except from the occasional variances. Meanwhile, random forest has a much larger deviation, especially towards the end, and it struggles to track the more unpredictable ranges and the more upward trends. This visual alone tells us a very important story and lets us know where the models excel and where the models eventually fall flat and do worse. To evaluate the models, we didn't just use one number, we used 4 different metrics that tells us different specific things about their performance in each area to get an overall bigger picture on how they performed. RSME, which is root mean squared error, measures big mistakes more aggressively, which matters a lot in finance. Large errors can be very costly. MAE is easier to interpret because it tells us the average error in actual dollars, and it gives us a more visually easy to accept answer. R squared tells us how much of the market movement the model can actually account for. For example, a high R squared means the model understands the trend and is relatively accurate. Finally, the MAPE, which is the mean absolute percentage error, just shows the overall error percentage relative to the stock's price, which helps us compare models even if we use different tickers. Using these metrics, we were able to see where the models performed well and what they struggled with and what improvements we could have made. Here we take an actual look at the metric values and can see the differences extremely clearly. Linear regression outperforms random forest in every single category. Looking at RSME and MAE, random forest makes errors that are 5 to 6 times larger, which means that in practice, its predictions are far less reliable, which we were able to see in the line graphs shown before. The R2 is especially, the R squared is especially dramatic. Linear regression explains almost 98% of price movement, while random forest only explains about 22%, which is a huge gap and something you would not want to use for a stock model prediction. Finally, the MAPE shows that on average it's off by 1%, while random forest is closer to 5% overall, which is a lot more inaccurate, even though percentage wise it seems smaller. In an actual real case scenario, these percentages can lead to millions of dollars of loss. So this overall, these metrics confirm that linear regression is in all metrics a better model than random forest for financial stock market predictions.
So why did the random forest get outperformed by linear regression? The simplest answer to this question is that the stock prediction problem behaves like a linear relationship where the technical indicators inform the future price. Linear regression fits the structure naturally, which is why it generalizes well and produces stable predictions. Financial indicators like moving averages, RSI, MACD, and volatility measures often interact linearly with upcoming short-term price moves. The random forest, on the other hand, tends to model nonlinear jumps and discontinuous splits, which is a major weakness for models trying to map function over time because they can break time-dependent relationships. Linear regression's strong R2 score of 98% shows that the features contain enough linearly explainable signal for the linear regression to exploit effectively. Random forest treats each row as an independent observation, ignoring sequential order, which is a major weakness for time series. Tree splits cannot naturally capture smooth trends, momentum, or lag dependencies unless explicitly engineered. Random forests are likely to overfit noise, learning small local patterns instead of global price movement. The model predictions flatten out, indicating underfitting on upward and downward trends. With weak temporal structure and technical indicators that behave linearly, random forest never finds meaningful nonlinear patterns. So the key takeaway is that in time series forecasting, complex models like random forest and neural network are not guaranteed to outperform simpler ones, unless they're given temporal features or specialized architecture.
All right, my name is Joseph Ortega, and I'll be covering the takeaway slides and the future enhancement slides for our presentation. So for the final section, here are our main takeaways from our project. The biggest thing we noticed is that linear regression consistently outperformed random forest on every metric. Once we looked at the charts and indicators, it made sense. The features we engineered, like moving averages, RSI, MACD, Bollinger Bands, and lag values, mostly formed linear relationships with the next day price. Because of that, linear regression tracked the trends much more closely, while random forest struggled with the time series aspect and tended to flatten out. This showed us that a simpler model can actually work better when the data behavior is mostly linear. Overall, the big lesson we learned is that choosing a model that fits the data structure matters more than choosing the most complex model. For future improvements, there are several ways we can build on this. First, using true time series models like LSTMs, GRUs, or AIMA would help us capture the sequential patterns that random forest missed. We could also add more lag features, try additional indicators, or bring macroeconomic data to give the model more context. Another upgrade would be trying XGBoost or Light GBM, or tuning the random forest hyperparameters to see if performance improves. And finally, we could expand to multiple tickers and evaluate directional accuracy, not just how close the price is, but whether the model predicts up or down correctly. So overall, we built a strong baseline, and there's a clear path to making the model more accurate and useful. And that's our presentation. Thank you for watching.
Now I'll demonstrate our stock price prediction system in action. I have the Google Colab notebook open, and I'll walk you through the key steps to show you how it works. First, we fetch historical stock data. Our stock system is configured to predict Apple stock prices from 2019 to 2024. We use the Y Finance library to pull data from Yahoo Finance. After running the fetch data and engineer features cell, as you can see, we successfully retrieved over 1,400 trading days of data, including the open, high, low, close, and volume prices for each day. Now let's visualize what we created. First, the stock history chart. This chart shows Apple stock's price over time in blue, with 3 moving averages overlaid. Notice how the moving averages smooth out daily fluctuations and help identify overall trends. The bottom graph shows trading volume. You can see volume spikes during important market events. Next, the technical indicators chart. This chart displays 3 of the technical indicators. The top shows the Bollinger Bands. When price touches the upper band, it might be overbought. When it touches the lower band, it might be oversold. The middle shows RSI. Values above 70 suggest overbought conditions. Values below 70 suggest oversold conditions. The bottom shows MACD. When the blue line crosses above the red line, it's a bullish signal. Altogether, these visualizations help us understand the features we have created and they are examples of the 28 total features of our models we will use to make predictions. Now we train our two models. First, linear regression, which serves as our baseline. After running linear regressions, looking at the test results, the RMSE is 2.87. The mean absolute error is 2.12. R squared is 0.9786, meaning it explains 97.86% of price movements, and MAPE is 1.11%. Also, looking at the random forest training model results, the RMSE is 7.37. The mean absolute error is 10.72. R squared is 0.2180, explaining 21.80% of price movements. And MAP is 5.04%. Notice the significant difference linear regression has much lower errors and a much higher R squared score, which is a key finding we'll explore further. Let's visualize these results. First, the predictions comparison chart. This chart shows actual prices in blue versus predicted prices in orange for both models. The top subplot, you could see linear regression's predictions closely follow the actual price line. The orange and blue lines are almost on top of each other, showing excellent accuracy. In the bottom subplot, random forest predictions are shown. Notice how the orange line is flatter and deviates more from the blue actual price line, especially during upward trends. The visual difference clearly shows linear regression captures the market direction better. Now let's see the metrics comparison. This bar chart compares all four metrics side by side. You could see linear regression has lower RMSE and MAE and a much higher R squared score. The MAAP is also significantly lower at 1.11% versus random forest's 5.04%. Our demo confirms the key findings from our analysis. Linear regression significantly outperformed random forests across all evaluation metrics. Linear regression achieved on R squared of around 0.98% and RMSE of 2.87, while random forest had R squared of 0.22% and RMSE of 17.37. This demonstrates that simpler models can outperform more complex ones when the data relationships are linear, which is exactly what we found with our technical indicators. This completes our demonstration. The system successfully fetches data, engineers features, trains models, and generates both numerical metrics and visualizations for analysis.